Good morning. Thanks for coming. I thought I'd be very lonely this morning, but this is not bad. It's almost like a regular Friday. Okay, I hope the midterm went well for you. The key is up on the website if you care to browse, and hopefully we'll try to get it back to you on Monday. There's a quiz on Monday that will be on options. It'll be pretty short answer material, so you could really focus on Chapter 8. I'll have no trouble getting through Chapter 9 before Friday, and so I may even have a little time for review. Who knows? Basically, I have one more topic in 8, and then we'll go on to hedging with options on Monday, everything will fall into place because we're combining spot positions with futures and options, and so there's just this one additional step we have to take. So what I'd like to do today is talk about the Black-Scholes Formula. It's a very important development in the history of economics and finance. It was developed in the 1970s by two economists, Fisher Black and Myron Scholes. They won the Nobel Prize for this invention. Unfortunately, Fisher Black had passed away, so Myron won the prize. In recognition of the fact that the Black-Scholes formula has revolutionized the finance industry, basically they came up with a mathematical formula that allows you to calculate the fair price of a financial instrument, whether it's an option or an other derivative, that fluctuates over time. So obviously options on futures are a perfect application of this formula. It was originally developed for stock options, but has been applied to futures options and a number of other financial derivatives. And so the entire growth of the financial derivative industry is attributed by some to this invention by Black and Scholes. Some people relate this invention in economics, or at least equate it with something in science like the structure of the DNA. It was a very important development in economics, and our whole industry today in finance is pretty much built on this one formula, which is pretty amazing. Now, fortunately for you, we'll not go through the mathematics. There's really no point. It's fairly tedious. But I'm going to try and work through sort of the conceptual underpinning of the Black-Scholes formula. And we're interested in the formula for two reasons. One, we can use it to calculate a fair premium on a futures option. Secondly, we can use it to calculate the implied volatility. So the formula, as I say, is used to calculate the fair value of the premium, and it depends on these factors that we've been discussing in the last week or two. Obviously, it depends on the price of the underlying futures contract, the strike price. You know the difference between those sets the intrinsic value, and obviously the premium will fluctuate with the intrinsic value. Days to maturity, you know that that's time value. Volatility is extremely important in impacting the probability of whether the option will stay in the money or move out of the money. And finally, the risk-free rate of interest, because that's the opportunity cost of capital. Now, with the Black-Scholes, in its standard form, you plug everything into the formula and it gives you the option premium. Okay, so the formula is widely available now. I'm going to go to one place on the internet. Most traders will have it on a hand calculator. So you plug in the strike price, the underlying futures price, days to maturity, historical volatility of the interest rate, and it tells you what the premium ought to be. And amazingly enough, when you look at the market, quite often this formula gives you something that's very close to what the market's determining. In addition to that, what you could do is take the market premium and plug the market premium into the formula and then solve for volatility. Okay, so the traditional way is to solve for the premium, but that means coming up with an estimate of volatility. Everything but the volatility is very straightforward, right? We know what the strike price is, we know what the futures price is, days to maturity. There's no problem coming up with those numbers. The problem is coming up with volatility. That's very hard to estimate. What you can do is use historical volatility. In the Chapter 8, you'll see I have a few tables where I've estimated historical volatility, and it's reported as a percent of price. For example, in the case of crude oil, it's usually around, it's been 30 to 40% in the last few years. In the case of wheat, it's been more like 20 to 25%. So you can use that, but the volatility also changes with the market dynamics. And given what's happened in the crude oil market this past year, you might think that the volatility has risen. So you can also use the formula to determine the volatility, to solve for the volatility by plugging in the market premium. So let me go to this website. I hope you can read this. This is a website I mentioned in Chapter 8. It's called www.freeoptionpricing.com. And you see that they have a number of different calculators. And there's one here for free futures options calculator. Futures options calculator. If you're struggling with this section in Chapter 8, I suggest you go to this website and spend half an hour plugging numbers in and watching how the results change. So you go here and it says European Futures Options Calculator. So we'll go to that website. It's the difference between the European and American option in terms of the actual premium is not significant. It's not huge. Remember, the European option you cannot exercise until the delivery month, whereas the American option you can exercise at any time. With the European, yeah. And so that's what this formula is, okay? Just so we're clear, this formula is not for the American version of options on futures, it's for the European. But it's not going to affect our results dramatically. So this will test your eyesight, but I'll tell you what I'm plugging in here. So it asks you for the futures price, and these are the numbers I'm going to put in. I looked at the sheet that I handed out a few weeks ago on options prices, and we had crude oil, and we were looking at the February contract, and the futures price, February futures were trading at 30.50. I don't know if you have that handout with you, but that was the futures price. And we were looking at a strike price of $31 even. So if we plug those numbers in, so up here it asks you for the futures price, so I'll put in 30.50. It asks you for the volatility. Let's leave that for a minute. It asks you for the interest rate. It has 0.08. The rate's less than that now. I'm going to put in 0.03. It asks you for expiration. That's time to expiry. So at the time we were looking at this, expiry was about 2 months, or 2 over 12, which would give us 0.16. So put 0.16 in expiry. So that's the fraction of the year left. And then it asks you for the strike price, and our strike price is $31. Now we have to worry about the volatility. The default is 25%, but I think we know in crude oil it's higher than that. You can see the table in Chapter 8. As I said, it ranges obviously and changes all the time. But right now it's somewhere between 30 and 40%. So why don't I put in 35% on volatility? Okay. So expiry is 0.16 in case you can't read the screen. Can anybody read the screen? Front row? Okay, thanks. Volatility, what did I say, 0.35? Okay, so I think we have everything here. The interest rate is 3%. That's not as critical. Okay. So that's those were the characteristics of that crude oil options contract we looked at a few weeks ago. And of course, the Wall Street reports what the market prices were, and now it's fun to compare it to what the formula would say. Okay, so you just hit calculate, and we come up with a call of, what is that, 1.47. So the call is 1.47, and the put 1.96. Thank you. The put is 1.96. This is according to the Black-Scholes formula. And if we look at the Wall Street Journal that I handed you a few weeks ago, according to the market call was 1.43, so it's pretty darn close, and the market put was 1.93. Again, very close. So this is why the Black-Scholes is held in awe by the financial industry. We simply, plugged in these very few variables and more or less guessed at the volatility, but we know it's probably between 3 and 4, and came up with a premium that's extremely close to what the market determines, where you have, hundreds of thousands of buyers and sellers coming together and determining the premium. So perhaps they all have the Black-Scholes in their head, I don't know, but this just illustrates why it's a useful formula. Yes?
The ones in the Wall Street Journal, are those American or European?
They're American.
American, so very good close.
That's right. Yeah, very close. Okay. So I suggest that you maybe pick another contract and do the same thing. And then what we could also do is we could see how changing these variables affects the premiums, and that's really the essence of what's left in Chapter 8. So we had a strike price of 31. Suppose we set the strike at 33. So what do you suppose would happen to those premiums if we bump the strike up to 33? Okay, thank you. So let's try it. So you're saying the put's going up, it's at 1.96, the call's going down, so 1.47. Voila. The put goes up to 3.27, and the call drops to 0.79 as we raise the strike. You'll notice that the delta, I'll just go back, I'm sorry. We had a strike of 31, correct? On the strike of 31, the delta was essentially 0.5, 0.47, and the delta measures the change in the premium associated with the change in the futures price. And because the futures is $30.50, the strike is 31, essentially this option's at the money. So the delta was right around 0.5 on the call. If we change that strike to 33, so we're raising the strike, we're holding the futures at 30.50, then it's going to move out of the money, correct? We calculate the delta drops down to 0.3. So that's another thing you can do, is see how these Greek letters, Greek numbers change when you start changing some of the variables. Yes? It's the change in the premium associated with the change in the futures price. Okay? So if the futures price went up by 10%, the premium went up by 10%, then the delta would be 1. Okay? So let's roll the clock ahead now. Yes?
How important of a factor is volatility in the Black-Scholes formula?
Could you repeat that, please?
How important is the volatility as a factor in the Black-Scholes formula?
How important is the volatility in the Black-Scholes? Very important, highly important, extremely important. It's critical. That's a tough one. I mean, that's a good question, and it's one that traders struggle with. And I'm hoping to try and illustrate that with an example. These numbers were from 2 weeks ago, and let's look at what's going on in the market today. Then maybe I'll come back to your question. And the answer is basically you have to estimate it. Everything else is very clear, but the volatility, that's up to you. And if you think the market is wrong and you're right, I mean, that's one trading strategy. You think the volatility is something different than what the market participants are saying, then the premium is going to be different than what you think it ought to be, and it's a chance for a trading opportunity for you. So most traders actually focus on volatility because it's that important unknown out there. Yes? Did you have a question? You think you're going to answer it? Okay. I hope so. If not, bring it up, okay? So 2 weeks later, it was about 2 weeks ago I gave you that handout, right? What's happened in the oil market? Pardon? Anybody bought gas lately? Down. It's down. Okay, so if you look at February futures today, February futures are 29.15. Okay, and they were at, what were they? 30.50. So the market's off. So let's go into the formula here now. I have everything set up right. So I want to put in a futures price of 29.15. Basically, I want to compare it, to those results over there. Okay, volatility of 0.35, interest rate of 0.03. Do I have to change the expiry? Yes, that's days to expiry. Okay, it's days to expiry. A few weeks have gone by. So the number is going to be lower, okay? It's going to be a little bit lower. Because the Black-Scholes puts a lot of weight on time to expiry. Obviously, the more time to expiry, the more uncertainty there is. So I'll drop that number to 0.13. Okay. Time to expiry, 0.13 from 0.16. I've left the volatility at 0.35. Oh, I want to go back to, what do we have for strike? We had, trying to keep all these papers straight. We had a strike of 31, didn't we? Okay, 31, whoops. Right, percent of the year.
So we're going from now till February, right?
There's fewer days, yeah. What I did over here, this is an approximation, right? A couple weeks ago, these options will expire in late January, so I just took 2 months. Maybe this should have been slightly higher, but anyway, the number has to drop a little bit, okay? So we got a strike of 31, okay? So what's going to happen to our premiums, do you think? We're keeping the strike at 31, so it was a right to go long at 31. The option there was almost at the money, right? Because the futures was 30.50. Now the futures are at 29.15. What's going to happen to the call premium, do you think? It's going to go down because it's moved. It was a little bit out of the money, but it's moved further out of the money, right? Does everybody see that? Okay. Good. Okay. I know the hardcore are here today. I know. Okay, I see it's 0.76 on the call. The call is 0.76, and the put is 2.6. That's dollars, okay? You all see that? So that gives me a price of 0.76 and 2.6 on the put. And then when I look in the market today, I check the market. The market says on the call it's actually 0.93, and on the put it's 2.37. So a couple of observations here. The market is 0.93. Over here the market was 1.43. So the market's come down as you said it would on the call. The put was 1.93, and now it's 2.37. So the put premium has gone up. Okay, I didn't ask you that question, but that's the answer you would have given me. So that makes sense. But now we compare it to the Black-Scholes, and you see it's not quite as close as it was over there, right? So what do you suppose is going on here? Here we come up with some numbers that were very close to the market. We modified the formula to account for the fact that the futures prices dropped, that we're closer to expiry. What's left? Volatility. So maybe something has happened to the volatility. It gets back to your question at the back. Or maybe not. Maybe the market's out of whack, and we're the only ones that know what's going on. In this room, we know what's going on in the oil market, but New York doesn't. Yes? Well, the time value is going to be less here than it will over there. Time value just, more or less reflects overall uncertainty. Maybe I'm not understanding your question completely, but. Price of oil, yeah. Okay, so, but that's another way of saying what he's just said, right? Volatility, right? So let's go and adjust that volatility number, right? It was 0.35. I left it at the same level as it was over there. Let's change it to 4 and see what happens. So I bumped the volatility up to 4. So here the volatility equals 3.5. I'll change the volatility equal to 0.4. You seem to be telling me that the oil market is, 1 second, I'll get to you. The oil market is more uncertain these days. So our premium on the call goes up to 0.95, okay, close to the market. The premium on the put is 2.79. The put is 2.79. So we still see a discrepancy here, but the call premiums are very close. Yes?
There's a 40% chance of such and such occurring, like this much a price change, or
It's the way the Black-Scholes records it. It's basically the standard deviation as a percent of the price. So what does that mean? It basically means that if you take the average price, let's say over the past year it's $30 a barrel, and then it might range anywhere plus or minus 40% from there. what some traders do is they estimate it from historical data. And you see in Chapter 8, I have two tables there where I simply took historical data and estimated volatility. So that's one way to do it. But clearly volatility is changing all the time. And some markets are more volatile than others. I mean, crude oil is more volatile than wheat, or at least it has been. So we know in crude oil it's probably 0.3 to 0.4, and wheat it's around 0.2 or something like that. But it changes a lot, and you can see that a small change in the volatility will have a big impact on the premium. So it gets back to the question in the back of the room. Volatility is very critical. I mean, does that help you understand it a little bit? Yeah, okay. Yes?
In historical context, that's more of a technical trading aspect, and then I would think that the fundamental aspect would be something else.
Well, what else is there? I mean, that's the problem with volatility, right? It's a statistical measure of the variance of the price, right? Square root of the variance. And its best estimate is probably what the market has been doing for the last 2 years in terms of gyrations. But who knows? That may not be a very good estimate, but it's all we have. So it's something it's hard to nail down. And that's what all these questions are underscoring, the fact that it is hard to nail down. You're absolutely right. And traders have the same concerns that you do. Everything else we know but the volatility. But just for the heck of it, what we did was we bumped the volatility up because that was one of the answers. Maybe the difference between 0.76 and 0.93 was because the market became more volatile. And as we bumped it up, we saw that it brought the call premium closer, the theoretical call premium closer to the market, but actually the put premium moved a little bit further away. So, you know, I can't explain this. There's something going on in the oil market right now where perhaps the traders are trying to assess what the volatility is. There is still a lot of uncertainty going forward, and it appears that maybe there's a trading opportunity here. You know, I don't know, but again, the important point is to have a feel, that you have a feel for how these factors do affect the premium. And you've been giving me the right answers, which is great. You know, we start changing this one variable, what happens to the premium? It goes this way or that way. We start changing the volatility. What happens to the premium? It goes this way or that way. And essentially, that's what the Black-Scholes model does, is it takes all these factors and tells you what the premium ought to be. So you change one factor, it gives you a new premium. Okay? Your rellies will wonder, what are you doing on Thanksgiving on this www.freeoptionpricing.com? But you just tell them it's important. Okay, so let's talk about these Greek letters in the Black-Scholes formula. We've spent some time describing them, but let's become a little more formal, okay? So I've talked about the delta effect. Somebody asked me what that meant. It's a change in the premium associated with the change in the futures price. Also, the delta will change over time, as we saw in this example, right? The option moved further out of the money, and the delta went down. So as the market moves, the delta will change. So the rate of change in the delta is called the gamma effect. Okay, that's the second Greek letter in the Black-Scholes formula. And the www.freeoptionpricing.com gives you all these Greek results. So have a look at those as well. The third one, change in premium associated with a change in time, that's called the Theta Effect. And we know how that works. We saw that as time goes down, we get closer to expiry, the premiums ought to fall. The change in premium associated with volatility, that's what we've been discussing. That's called the lambda effect. Okay? And here is the mathematical description of each of these Greek components. Delta is a change in the premium, where P is premium, associated with a change in the futures price. F is futures price. Lambda is change in the premium with change in V for volatility. Theta is change in the premium with a change in T for time. Gamma is a change in delta up here, right, with a change in the futures price, because as the futures price changes, that delta is going to be rising and falling, and we know that it's around 0.5 for an option that's at the money. Okay. So this table summarizes the Greek effects for either a call or a put. Some of these factors we've already discussed with this example we had on the board. And really understanding the Black-Scholes conceptually is being able to fill in the blanks in this table. So if I give you a blank table like this, where I have the top row and the left-hand column, if I give you that blank table, and you can fill it in for me, then you understand the Black-Scholes formula. Unless you're very lucky. Okay. So it's an important table. Change in the variable. Well, we have futures price, volatility, and time to expiry. Those are the important ones. We don't worry about interest rate too much. And we have the calls and the puts. And we know that either the futures price can rise or fall, volatility can go up or down, and time to expiry, if we're looking at 2 different months, can be higher or lower. So how does that affect the premium? You've already given me some of these answers when we were going through our example. If the futures price rises, okay, well, the call option premium will increase and the put option premium will decrease. Does that make sense? We're holding the strike price constant. So if you raise the futures price, and let's suppose that the option is out of the money, as this one here was slightly out of the money, and what happened was the futures price fell, so the premium fell. So at least it was that positive relationship, right? If we went from this example to that example, it was actually the second row of this table. So maybe I should focus on that. This one right here. That's the example we just discussed. We had the futures price falling from 30.50 to 29.15. What happened to the call option premium? It fell. What happened to the put option premium? It increased. So there's a positive sign on the call delta and a negative sign on the put delta, because it will move in an inverse fashion to the futures price, holding the strike price constant. Okay. You understand? Happy Thanksgiving. He's got a turkey in the oven. He's got it. Second element, volatility. Okay, we found that, let's see, what did we find here? We found that when the futures price fell, the call premium fell, and the market premium, excuse me, was higher than what the Black-Scholes formula was telling us. And so we played with the formula a bit to try and get a better understanding of maybe why that theoretical value was lower than the market value. So as we increase the volatility, we increase the premium, which makes sense. If you increase the volatility, which is an estimate of the extent to which the price can swing above or below its average level, then the premiums ought to rise because those that are selling the option are assessing the probability that either A, it's going to move in the money, or B, it's going to stay in the money. And as you enter a more volatile market, and if it's out of the money, well, chances are now greater that it will move into the money if the volatility is increased. And so that's what these premiums are reflecting. They're reflecting basically the probabilities that the sellers of the premium and the buyers are assessing. They all have the same information, so it makes sense that the premium would rise. Yes?
This saying the volatility will increase if it's call or put. For that one, we had the volatility or the premium drop when it rose.
Yeah, and it might have been because I adjusted the time value too. I don't know. This was from the theoretical one, right? No, it went up. I'm sorry. It went to 2.79. I didn't write this down, but this was the Black-Scholes result, and then this I hadn't changed the volatility here. Okay. No change in volatility, right? And then this one. No, I'm sorry, that's just the market, isn't it? That's the market, okay. Here's the change in volatility, okay? I should have made this more clear. The volatility went up to 0.4, and the put went from 2.6 to 2.79, and the call went from 0.76 to 0.95. So I think they did both rise, okay? You were just looking at the other column, I think. Yeah, yeah. Scared me for a minute. But I've used that website before, and I think it's pretty accurate. So they both rose, and that's why the put became a little more distant from what the market was, even though the call became closer, because you're going to increase both of them when you increase the volatility. And in time to expiry, I think we beat that one to death. I think you understand how that works. Again, it's a question of additional uncertainty the more time there is between now and maturity. Okay? So you reckon you could fill this table in if I gave you a blank one? Okay. So practice that. Okay. So we're still on the same path of trying to understand the Black-Scholes conceptually. We have an example here that illustrated what happens to the premiums when we change the variables. I showed you the table. And now I want to go back to our discussion, I guess it was Monday, when I showed you the theoretical maximum and minimum prices for calls and puts. Remember we looked at that box that had the area in which the premium could lie, and then the most probable path, and the Black-Scholes will give you an estimate of where in that box it lies. So let's sort of go back to that and talk some more about these Greek factors, okay? So here's the delta effect. It's an important Greek letter. We've got a call option, and we're looking at the impact of an increase in the futures price on the call option. So let's assume that the strike price is fixed, and let's just focus on an out-of-the-money option so we're not worrying about intrinsic value here. So there's a couple of things. One is, on Monday we decided that the most that anyone would pay for a call option would be the futures price. You'd never pay more than the futures price for the call option. So if we draw a demand curve, this is the demand for call options expressed by the traders. If we draw a demand curve is downward sloping, as they normally are, it's going to hit that vertical axis at the initial futures price, because that's the most anybody would pay. The demand is their willingness to pay. Nobody would pay more than that. And the supply curve will be upward sloping. It's offered by the writers of the option. Obviously, if you don't offer any premium, if it's zero, they're not going to write any options. But the higher the premium, everything else held constant, the more options that will be offered, correct? So in the trading pit, this is what we have. I mean, the trading pit conceptually is reflecting this supply and demand. And so where supply and demand meets, that's our premium and our volume of trade, holding the strike price constant, given a certain futures price, holding time to expiry constant, everything. So this is a snapshot today. We'd have an equilibrium where there would be a premium and a volume of trade. So now let's change the futures price, see what happens. Okay, what's going to happen to the premium if we raise the futures price, call option? Sideways? Up. Okay. Thank you. So that's one element in the table that you told me you could fill in, right? And if you can't remember, think about this diagram maybe. So the dashed line is day 2. Okay, the solid line is day 1. Day 1, we had D1 and S1, initial premium at P1. What's happened? Well, all that's changed is the futures price is increased, right? The example I gave you on the board, the futures price fell. It's just going the other way now. And we saw when it fell, the call premium went down. Now we see when it rises, the call premium goes up. Why does it go up? Well, for a couple of reasons. One is the demand curve shifts, and secondly, the supply curve shifts. So prices change. Why does the demand curve shift? Well, we have a higher futures price. And remember, the intercept on the demand curve on the vertical axis is the futures price. So now if the futures price has risen, the maximum willingness to pay is higher, so the demand curve is shifted up in a parallel fashion. So it hits the vertical axis at the higher futures price. So we have a higher demand curve, D2, it shifted to the right. And what about the supply curve? Well, we say the supply curve rotates. It doesn't shift in a vertical fashion. We say it rotates left. Now, why would that be? Well, remember, the supply curve is the schedule that the writers of the option present in the trading pit. They're willing to sell various volumes depending on the premium. If you want to bid the premium up, I'll sell you more options. And so yesterday I was willing to sell along this path. Now you come to me today and you want to buy the same volume from me. Okay, so suppose yesterday, well, let's suppose you and I are the only ones in the pit. Yesterday we bought this volume, and now today you come along and you want to buy the same volume, and you're asking whether I will charge a higher or lower price. Well, the futures price has risen. This is a call option. It's out of the money. So if the futures price rises, then is that option getting closer to the money or further away? Closer. So if it's getting closer to the money, and I am a rational trader trying to make a living at this, and I'm selling you options, if it's getting closer to the money, will I ask more or less for the same option today? More. I'm not a fool, right? It's moving closer to the money. Once it moves into the money, then any premium I get starts to erode, right? The premium is the most I can make. So if it starts to move towards the money, I start to sweat, think, God, I'm going to lose everything. So if it's moving up, then I'm still willing to write options, but for every unit that I write, I'm going to ask you a higher price. So I want a higher price for every unit that I write compared to yesterday because the futures price has risen. You're actually willing to pay more because the futures price has risen, you being the buyers, me being the seller. So it's no big surprise that on day 2, we have a new equilibrium right here, which gives us a higher premium, even for the identical volume, for the same volume. Hold the volume constant. So that's why the premium rises when the futures price increases, using something that's more familiar to you. Good old supply and demand diagrams, right? The Black-Scholes doesn't look that familiar. It's very complicated, very messy. Supply and demand diagrams, very familiar to you. So we can use those diagrams to also understand how these Greek variables are determined. And so we see the delta is positive for a call option because when the futures price rises, the premium rises as well. Okay, have a great long weekend. I'll see you Monday.